Yes, so we are going to start the consolidation in corporate reporting, which is an advanced one. But what is going to happen is that the advanced issue is not that uh, much in the corporate reporting. It's just that there are some small things, but the consolidation will still be the basic one. The consolidation will still be the basic one. We'll still be doing the basic things, but just that it will be small things that we are going to be having. Okay, so we are going to be looking at changes in group structure, which we are starting with step acquisition. We look at what we call disposal situations. We look at the complex groups. Then we look at consolidated statement of cash flow, and we also look at accounting for foreign subsidiary. So if you count to corporate reporting, we have 5 major issues on the consolidation, but the examiner likes the step acquisition, complex group structure. Yeah, those are the two major areas that they like setting questions on. Okay, but as far as the syllabus is concerned, they are here to examine cash flow. Okay, as far as the syllabus is concerned, they are here to examine cash flow. Although they haven't examined a foreign subsidiary as a as a question on its own, but they have done it before. They have added it to a disposal where you have to translate the foreign subsidiary over there before you can go with it. But cash flow is here to be examined. But they like examining the step acquisition and the complex group structure. Okay, so we will start with what we call the step acquisition. Okay, there's only 2 issues over there. Apart from that, everything about consolidation will still be in this particular uh, issue. That's why I've asked you to join the basic one, because most of the time, if I start with the advanced consolidation, most people they complain because they say that most of them they are using masters to write the IC, so they don't have the basics like that. Okay, so I have to start with the basic consolidation so that even if whatever adjustment that we'll be doing under advanced level, it will not be something that we have to talk much about it. All right. So the basic consolidation, okay, what we looked at is that the parent company or the investor will just acquire the shares in the what? In the investee or the subsidiary. It will just a one time. They'll just acquire the shares in one transaction. Then they will what? They will gain control. So the question that we have solved, or the question that we have solved so far under the basic one, what happened is that there will be just a transaction. In a single transaction, the parent will acquire more than what? 50% of the equity shares. So control will be achieved in only one transaction. But in reality, that is not always the case. Okay, that is not always the case. The parents can acquire the shares, or the parents can get control in what? In a lot of transactions. So that is what we are coming to look at. But for basic one, the control will be achieved in just a single transaction. The company will acquire the shares in the what? In the other company, and more than 50% will be what? Will be acquired. But in real situations, that is not always the case. Okay, so we can have a situation where the investor will acquire 10% first. They want to know whether the company is what? The company is doing what, that they can acquire all of them. So they can acquire only 10% in the first year. They can acquire 10% in the first year, which will be 2021. Okay, so in 2022, they will acquire what? Additional 20%. What is their entire holding in the company now? What will be the entire holding in the company now? At the end of 2022, what will be the entire holding in the investment?
30%.
30%. you can see that still all things being equal, control is not achieved. Okay. Then in 2023, they can decide to what? To acquire what? Additional 40%. So in 2023, maybe this was done on July. Okay, 1st July. Okay, on 1st July, what is the entire holding in the company now?
20.
Okay, that will be 70, isn't it?
Yes, please.
Okay. So you can see that 17 now is giving them control, isn't it? So we can say that this particular company achieved control or obtained control over the other company on 1st July 2023. So it is from this day that they will start consolidating. Consolidation starts from the day that you achieve control over the company. You can see that the control of 70% is now achieved in what? In a lot of transactions. That's what we call a step acquisition. The control is going to be achieved in stages or in steps. It will not be in a single transaction. But for financial reporting, you are going to be given a question that control will be achieved in a single transaction. But in reality, that will not be possible, or that might not be what? That might not be the case. So the parent will continue buying shares till they get what? They get the more than what? More than 50%. And from that date, that is where they will start consolidating. Consolidating will start from the date that you achieve control over the what? Over the investee. So calculation of goodwill, anything about consolidation will start from July 2023. Okay. There can also be, this is one side, there can also be a situation where, okay, in a single transaction, which will be 2021, we can acquire 55% of the company. So in 2021, let's say this happened July, this also happened July 1. Okay. In 2021, do we have control over the what? Over the other company that we are buying the shares in? Do you have control? In the first transaction, we have control, isn't it?
Yes.
It can happen that in 2022, we will decide to buy additional shares. So maybe July 2022 again, we decide to purchase additional shares. So what will be the shares that we are having now?
70.
Okay. Okay. The question is, after the control, where are we buying these shares from? The 15%, where are we buying it from? Are we buying it from outsiders? Are we buying from different company? We are buying it in the same what company, isn't it? Okay. At the time of control, we are having 55 against 45 for NCI, isn't it? So the 55%, the 15% now, we are buying it in the same company. So where are we buying it from?
From
From the
NCI.
NCI.
We buy it from the NCI. So we have to also, so it means that from July, the parent will now be having 70%. NCI will now be having what? 30%. So any profit that will be made from July 2022, the parent will have a share of 70%. NCI will now have what? A share of 30%. But how do we account for the additional 15% that we are getting from what? From the NCI. So this is all about the step acquisition, the treatment. That is all. So the first one, which is control, is being achieved in stages. There is no big issue over there. It's just that a gain on the previous head instrument. That is what we are going to be looking at. The additional control, and you have additional acquisition from the NCI. How do we account for the amount that we are paying to the NCI? We might be paying more than what we are receiving, or the portion that we are receiving from NCI. How do we account for that? Is it going to be a gain? What is it going to be? How do we account for that? So we are going to look at those issues and solve one question. Okay, so the step acquisition is a situation where a control will be gained in stages, or a control will be gained in the first transaction, but we are going to acquire a further shares from what? From NCI. We want to increase our what? Our shareholding in the company. So we purchase additional shares from what? From the NCI. So step acquisition, we have from non-control to control. Non-control to control, that is the first one. Non-control to control. The non-control to the control is the first example that I've done. So you are not having control, you are not having control, now you have control. So all of these years, you are not having control. So that is non-control that we call. And you now have control now. So if you have no control to control, where will be, we have 10% first, we have 30%, then we now have 40%. So we now have a control at the last date of buying the 40%. Okay, this is what we call the non-control to control. How do we account for this? How do we account for this? Okay, what will happen is that the parent purchase the shares using what? They purchase 30% using what? Cash or maybe share or anything, any form of consideration. And before they acquire the 40% and 30%, they have been accounting for the 10% in a certain way. 10% can be accounted for as a financial asset. So maybe they might be using other comprehensive income or profit or loss. Okay, the time that they are going to acquire the 30%, it will not give them 40%. So maybe this might be accounted for in accordance with IS 28, investment in associates. Okay, so at this date now, okay, you are going to pay additional amounts. The question now is, at the time that you are acquiring the additional 40%, what is the value of your existing investment? So the question will give you the fair value. Okay, so I will talk about only the goodwill calculation, because it's only the goodwill calculation that will change there. So your purchase consideration for all this one. So you have the purchase consideration for 40%, which is the amount that we are paying now. So what is the purchase consideration for the 40%? So the question will give you the additional amount paid, and that will be the fair value. Okay. But if you come to the existing investment, you ask yourself, what is the fair value today? It means that you have to recognize the investment. You have to remeasure the investment before you now recognize it as purchase consideration. So what will happen is that the existing investment should always be fair value before you treat it as as a purchase consideration. The meaning is that if the question is saying that the company is recognizing the 10% and 30% at cost, and their cost given to you is 120 million. Okay, the question will give you maybe the fair value to be 150. Okay, the question now is, if you want to pay for the 40% now, okay, it will be done like you are purchasing all the 70% now. So if you want to pay for the 40% now, how much is it? It is worth 150, but you purchase it for 120. It means that you are going to be having a gain of 30. Or you assume that you sold the existing 40%. You sold it to somebody. You sold it to somebody. So you bought it 120. You are going to sell it for 150. So it means that you make a gain of what? Of 30 million. But on the same day, you are going to repurchase it back. So if you are going to buy it back, it means that you buy it at what? 150. So you bring the 150 as the new value there, which will be, so this will be 30% rather. The first one will be 30%. So this will now be 40%. The purchase consideration will be at fair value. Okay, so you always measure the existing one at what? At fair value. Any gain or loss will be taken to profit or loss or retained earnings, depending on the statement that you are preparing. So you assume that you have sold that particular value and you are buying it back. So if you sell it, you are going to have a gain. And if you are buying it back, you buy it at a fair value. So you use the fair value for what? For the calculation of the goodwill. Any gain or loss on that will be taken to profit or loss as a fair value gain or retained earnings, depending on the statement that you are preparing. If you are preparing statement of financial position, it will be taken to retained earnings. If you are preparing statement of profit or loss, then you look for the portion of the gain that relates to the current year, because maybe the gain might be for maybe the 2 years that you have acquired. So the question will give you information on the gain that will go towards the current year profit or loss. So maybe they might give you a value for each of the years. So you just look for the increment for the current year. That will go to the profit or loss. So for non-control to control, the only thing is a gain on the what? On the already had what? Investments. Okay. When do we consolidate? Okay. The one thing that you have to know is that you can only consolidate an entity if you have control over that particular entity. So consolidation starts from the day that we have the control of the 70. So it will start from the day that you have acquired the additional 40 to have control. So consolidation starts from the date of control. Consolidation starts from the date. Consolidation starts from the date that we have obtained control, from the date of control. So consolidation starts from the date of control. Okay. And the calculation of goodwill, everything about consolidation starts from this date. Okay. Calculation of goodwill also starts from that date. NCI, everything about consolidation will start from the day that you have achieved control. The day that you have purchased the shares, you now have a control over them. So it will start from the date that your total holding is giving you control. That will be the day that you have purchased the additional 40%. That is all about what? From non-control to control. Please, any question before I will go to the control to control? Then we just pick a question and then we see how far we can go. Okay. So let me just take the silence that we know everything already, and we just want to see how far that we can go with a question. Okay. Please, wherever you are, be trying your best. I hope you have seen the pass rate over the last three sittings for 2023. It's not easy, but people are passing. Okay. People are passing. So you have to, yes, I can tell you that. You see, sometimes if you look at a corporate reporting paper from maybe November or from April 2022 there to the down to the time that the syllabus was introduced, you feel like you should have written the paper those time, because from August to now, you can see that there is a change in how the questions are being set. Okay, so you have to really try your best, because right now the direction that they are going, they won't come down. Okay, so let's try our best, especially if you take the standards. Just ask yourself, what are the advanced issues? Because right now they want to differentiate financial reporting from corporate reporting. So they cannot be asking you questions on borrowing costs, investment property. Those standards are for financial reporting as a standard on each one. Your own now will now be impairment, but the impairment will not be just a normal impairment. If they want to ask you a question on a single impairment of a single asset, it will be a question that you have to think. It will not be those ones that you just go forward and do your calculation and move on. No. They will ask you questions that cannot be in financial reporting. So even any special, Charlie, you don't have to go there. They will load it for you. Lazy, Charlie. So let's try our best. Let's try our best. The things that you can use to get a marks is the ratio, the specialized transaction, the ethics, and then the consolidation. Consolidation is not all the adjustment that you can do. So you can just put your skeleton there. I will show you how you can answer the consolidation question. Put your skeleton there. Yes, whatever you are going to happen, you'll be adding two figures. You'll be consolidating. So bring the parent own. Parent own, you don't have to pro rata anything. So if it's statement of financial position, just identify who the subsidiaries are. Bring their figures there before you start coming to the footnote one by one to see which one you can actually tackle. Then you move on. Okay. So at least you'll get something there. So let's try, because if they should If you're not able to get it for this sitting, and they are changing the syllabus is coming with a different thing. So you will not see questions on only business valuation and capital reorganization as a question number 4. You will now be preparing an account for insurance companies, banks, and that will be like final account, what you are moving from, and the footnote will be full of standards. So let's try our best. All right. Let's come to control to control. From control to control, the situation is the parent already has a control, or the investor already have control, and they are buying additional shares to increase their holding in that particular company. So what will happen is that the first transaction, they have acquired 55%. Okay, so they have control. We start consolidating, all right, but they decide to acquire additional 15%. So this 15% will be accounted for as we are buying, we have 55%. The other people, the portion that we are not controlling, they are having 45. Now we are buying 15% in the same company. It means that we are buying 15% from the non-controlling interest. So what we do is that at the date of this transaction, how much are we paying to the NCI? So the question will give you the consideration to NCI. Then we ask ourselves, what is the percentage of the what? Of the NCI that we are buying, which represent what? 15%. Okay. So what you do is that maybe they will give you a question. They will give you the figures. That's the purchase consideration for the 15%. Okay. That you are paying 40 million. Okay. At the date that you are buying the additional shares, you have to determine the value of what? Of the NCI. So maybe the question can give you the MCM value at that date, or they will give you information that you can determine the NCI. So maybe they can give you the NCI value at acquisition. Then they will give you the post-acquisition profits. So the only thing that will increase the NCI value is the post-acquisition profits and what maybe impairment of goodwill if we are using a full goodwill method. Okay, so let's assume that the time that we are buying the NCI, their value, okay, their total value were what? 120 million, or let me just say 135. Okay. So this was 135 million. Okay, this 135 represents how many percentage? The NCI value at the time that we are buying them is 135. It represents what percentage? Okay, that will be 45, isn't it?
Yeah.
Okay, but we are buying 15%. So we ask ourselves, what portion of the 45% represent what? The 15%. The 45% is the 135. So 15% will be what? We just look at that. So the transfer from the NCI to the portion that we are buying from the NCI, so you just find it like this. Okay, the percentage that you are buying divided by the total NCI percentage, because the 135 over here is for the 45%. So we are buying 15. So that will be 15 over 45 multiplied by 135. What will be the value that we'll be getting from NCI?
45.
That will be
45 million.
okay. That will be 45 million. But how much are we paying?
40.
So you are receiving 5 in excess, isn't it?
Yeah.
Okay, that 5 should not be treated as a gain because the NCI is still there, and this is not our normal transaction. So whatever you are getting over there, whether a gain or loss, should be taken to other components of equity. So what you do is that you are going to debit your cash because you are paying to the NCI. You debit cash of 40 million. Okay, not cash, not you are debiting cash. Okay, NCI is just like what? It's just like a liability, isn't it? NCI is just like a liability. Is that correct?
Yes, that's correct.
Okay. So if we are going to remove 45 from NCI, so it's a liability, we debit the NCI. Okay, we debit the NCI with a portion that we are going to transfer from the NCI value at the date of this one. Okay, the NCI will now be 30%. That 30% will be the 135 minus what? 45. Then what we do is that we credit our cash because we are paying. That will be 40. Then we credit our other component of equity, not retained earnings, with a difference, which is 5 million. Okay, so if it is a loss, if we are paying more, that particular amount will still go to the other component of equity. If we are paying less, that's supposed to be a gain. It will still go to other components of equity. Okay, from the date, let's assume that it is January 1 that we purchased this one, but our reporting date is what? December 2022. So we purchased additional shares on January 2022. Okay, if you are preparing statement of profit or loss, what will happen now is that your profit for the year will be divided into two. The profit for the subsidiary will be divided into two. Okay, one of it will be January to June. Okay, from January to June, what was the NCA percentage?
45.
Okay, so we share the first profit. NCA will be having 45. The parent will be having 55. But from July to December, what will be the NCA share of the profit?
30.
Okay,
30%.
so the NCA will have it 30, and then the parent will have what? 70.
70.
Okay, this is how you share it. You share the profit into two. Before you acquired additional shares, NCA was 45. So from January to June, NCA is still 45. So NCA will have 45 share of the post-acquisition profit of the subsidiary. Okay, but from July to December, you have acquired 15%. So it now NCA will now contribute only 30% to the profit. So NCA will have 30% share of the profit. So you split it and share accordingly. If you are coming to statement of financial position too, you do the sharing also like this. But for this one, it's not going to be an issue. That is why I have to talk about the statement of profit or loss. If you are doing statement of financial position too, the profit will also be shared like this. The first 6 months will be 45 against 55. The last 6 months will be 30 against what? 70%. Please, this is all about the step acquisition. The rest is just about the basic consolidation. So they can pick step acquisition for corporate reporting. They can just pick one of the issues and set questions on it. So they can pick complex group structure, they can pick step acquisition, they can pick disposal, or they can pick cash flow, or maybe foreign subsidiary and set question on it. But apart from that, everything about the consolidation, the basics will still be coming. The unrealized profits, the other intra-group trading, the adding of the figures line by line, determination of the net asset, all those things will still be the same thing. All those things will still be the same thing. All right. So that is that for that. Let's pick a question and we solve one question today and Saturday we solve additional question during our normal class. Okay. Question number 1, Ruby, Hail, and Zinc. Okay. Who will be the parent here?
Ruby.
So as soon as you know that Ruby is the parent, what are you going to do? You even know the reporting date. Can you see the reporting date there? The reporting date will always be the date at the top. So the date that the financial statement has been prepared, that is the date. Okay. So this is what? This is the date, the reporting date. And you know that the parent is already Ruby. So you don't have to go and worry yourself. You can just go straight forward. As soon as you see non-current asset, property, plant, and equipment, it is going to be statement of financial position. Unless maybe they want to add statement of profit or loss where you are going to go down. Okay, so Ruby. In corporate reporting, you see the first company is a parent. The second will be subsidiary. The third can still be a subsidiary or a sub-subsidiary. But for corporate reporting, we don't have issues of associates like that. No. It will be only financial reporting that a third company will be the associate. So since you are going to know that this question is about step acquisition, there will not be any disposal. So you just go straight forward to Ruby's group. You have the Ruby's group. Okay, consolidated statement of financial position. Okay, as at 31st May 2012. Okay, please, for statement of financial position, there is nothing like what? Apportionment over here. If you sell your business to me on the last day, the business is my own, not your own again. So I will still have control over your assets, but just that the profit that you have made for the year, I will not have any share of it. So it's only statement of profit or loss that we do the apportionment, because we want to know the portion of the profit that we are going to have a share of for the year. But for statement of financial position, if you are selling your company to me on the last day, the company is no longer your own. The assets are no longer your own. It's my own. But just that I will not have share of the profits. So for statement of financial position, there is nothing like apportionment of whether it has been the business has been acquired 3 months to the end of the year. You will still have the asset as your own. It's only the profit that you have only 3 months share of the profit. Okay, so we have the non-current assets here. Okay, we have the non-current assets. The first one is what? So that will be PPE. So the PPE, we have a PPE. Okay, so you just bring the parent value. Although we know that the second person will be a subsidiary, but you can bring the parent value, or 112 plus, let's add the other subsidiary to it. So let's come to the hill, which will be the 60. Okay, so the investment over there, we have investment in Hill and investment in Zinc. So this is just telling you that this is the parent with cash or maybe the purchase consideration in the other companies. So this will always cancel the equity shares of the subsidiaries. So you just have to ignore. Okay, but if they just put it investment over there, that is what we reconcile to see whether the parent is having other investments in addition to the investment in the subsidiaries. But since they are saying investment in Hill, investment in Zinc, we just have to ignore those ones and move on to other issues there. So maybe you will be having a goodwill. Okay, we'll be having a goodwill. Goodwill will come. We will be having other assets. We have financial assets also. We have jointly controlled operation. That will be the IFRS 11. So we have financial assets there. So we have financial assets. What is the value of financial asset for the parent and the first subsidiary?
9 and 6.
Okay, that will be 9 and 6. So 9 plus 6. Okay, please, because this is a step acquisition, that is why we are adding the second subsidiary to it. But if you have to go and read and see whether the question is a disposal, there might be that the current has disposed some of the shares in the second subsidiary, and that might result in a loss of control or anything. You have to go and determine those things before you start adding the subsidiary figure. But for the parent figure, whatever happened, the parent figure will come. Okay, then we have jointly controlled operation. Jointly controlled operation. Okay, how much is the figure there? That will
6.
Okay, that will give you 6. Okay. So this 6, then you can leave some space to count your current asset, because there can still be some assets that will be coming, but they are not in in this particular statement. Okay, So we have 5 and 7. We have 5 plus 7. So let's go to our equity and liabilities. Equity and our liabilities. So equity and liabilities, yes, please. It will be you who cannot hear me. Thank you. So we have the equity first here. Okay, so let's go to the equity items there.
The ordinary shares.
Okay, so we have the ordinary shares will be for owning who? Okay,
Parent.
the parent that will come here. So the ordinary shares. What is the parent figure?
25.
25. Okay. Then we have the group retained earnings, which we are going to do workings for. Okay. So the group retained earnings, you have to do workings for. But if the group retained earnings will not be plenty, you can add the items here. But because it is going to be having a lot of workings that we cannot add the figures over here, or we don't have a space, it will be better we go and do workings for the group retained earnings. We have other components of equity also there. Other component of equity. So we have the other component of equity. Okay, so we are done with those ones. Okay, what will be the other item that will come under the equity, but we not add it there? What will be the other one?
NCI.
Okay, so we have the non-controlling interest. Okay, so after we have canceled our investment with the shares, what is the portion that we are not having control over? That will be there for them. So we have non-current liabilities. Non-current liabilities for non-current liabilities. What is the amount for the non-current liabilities? The first two companies.
53 and 20.
Okay, 53 and 20. 53 plus 20. Okay, now we count to current liabilities. Okay, so current liabilities, what is the figure for them?
47 and 6.
4, 7, and 6. Okay, so with this one, we can now move on to the additional information. So the additional information, you don't even have to do anything. You can move on to your workings here now. Then your workings, you do your group structure, which we all know how to do. So the group structure, you put your parent there and each subsidiary, and then the percentage shareholding that they have, the acquisition date, the reporting date, and those things. Okay, so the two will now have with the net assets. Okay, so you do the net assets now, or maybe the first subsidiary, which will be the, okay. So let's come to acquisition. At acquisition, at reporting. Okay, so from here, we can just go now and start reading our footnote one by one to see the one that we can adjust. Okay, so let's look at the first one. Okay, the footnote one. Someone should take that for us.
Manos,
Yes, please.
please, may I know if you are doing the net asset, I want to find out if you can combine the subsidiary and the sub-subsidiary, can make it together so that you, instead of doing it individually? Can you do it in a combined form?
If you are doing a combined form, it's the same thing like doing it individually, because you'll be adding the two. You have the net assets for all of them, but just that the share capital will be the same item that we'll be using for it. So at the end of the day, you are just doing individually, but just that you are not going to be writing the share capital for all of them. If that will work for you, fine. For me, I don't have any problem with that. If that will work for you, fine. But you are going to, it's only the share capital, the retained earnings that you will not be writing twice. Okay. So if you can do all of them at once, I don't have any problem with that. So you can actually do that. But just that you can't add their share capital values to have a one share capital value. No, that cannot be possible. But you can just do like you have the net assets, the share capital, if you write it, you come and bring their values there one by one. So that will also be fine. Okay.
Thank you very much.
All right. Let's come to the footnote 1. Please pay attention to the date. Okay. The reporting date is 31 May 2012. Footnote 1. Who is reading that for us?
Okay, I read.
Okay.
On 1st June 2010, Ruby acquired 80% of the equity interest in Hale. The consideration comprised cash of $50 million. Ruby has treated the investment in Hale at a fair value through other comprehensive income, OCI. A dividend received from Hale on 1st January 2012 of $2 million has similarly been credited to OCI. It is Ruby policy to measure non-controlling interest at fair value, and this was $15 million on 1st June 2010.
Okay.
On 1st June 2010, the fair value of the identifiable net assets of Hale were $60 million, and the retained earnings of Hale were $60 million. The excess of the fair value of the net assets is due to an increase. Let me take it again.
Okay.
The excess of the fair value of the net assets is due to an increase in the value of the non-depreciable land.
All right, thank you. So let's tackle the first one first. Okay. So they are saying that on 1st June, 2 years ago, isn't it? That will be 2 years ago.
Yeah.
Okay. Ruby acquired 80% of the equity interest of Hale. The purchase consideration comprised cash of what, 50 million. Ruby has treated the investment in Hale at fair value through other comprehensive income. So this is a control. We have to consolidate them. We can't be treating these investments in accordance with what, with IFRS 9. No, this will be treated under the provisions of what, IFRS 3 and IFRS 10, business combination and consolidated financial statements. Let's come to investment in Hale. How much is that?
55.
Okay, it's 55. But what is the amount? What is the amount now? How much do we?
million.
Okay, so it means that the investment has increased by what?
5 million.
5 million. That is the gain that they have on the what? On the investment, because they are carrying it through other comprehensive income. So that is a fair value gain, but that fair value gain should not be recognized in the first place. So in this question, we can see so many issues here. So we go and what? Deal with those issues one by one. We can have the NCI, okay, but the NCI, what you do is that you put the NCI together. You do the NCI for the two companies together. Okay, so let's come to the non-controlling interest. Okay, we have the non-controlling interest here. So that will be the fair value at acquisition. At acquisition in the question is 50 million. Is that correct? Okay. So we can also come to group retained earnings here. So from that question, we can move on to group retained earnings now. So we have the group retained earnings. Okay. So let's come to group retained earnings. So we have the parent earnings. Okay. So let's go and pick the parent earnings from the statement of the financial position. What is the earnings for the parents?
70 million.
70.
Okay. So we can start with that now. 70 million. Okay. So we also have the group other component of equity. So group other component of equity. Okay. So the group other component of equity, we have the parent was other component of equity. How much is that?
11.
Okay, that will be 11. Okay, so we have this to be 11. Okay, what will happen now is that, can we start our goodwill? Can we also start with the goodwill calculation? Because we are giving the purchase consideration. So goodwill calculation, we do it for the two, just that we do the goodwill calculation and put the goodwill for the two companies together. So we have the purchase consideration for here. Okay, the purchase consideration is how much? How much do we pay for them? That will be 50 million, isn't it?
Million.
Okay.
Yeah.
The non-controlling interest is as what? Fair value. So you bring the non-controlling interest here. That will be 15 million. Okay. Let's go to the question there. Okay. Let's go to the question. Okay. So the purchase consideration at the date should have been what? The investment should have been 50 million. But now they are saying that it is 55 million. Okay. So where is the 5 million? Where can we find the 5 million in the parent book? In the parent books, where can we find the 5 million? Should there be any gain on the investment in the first place?
No.
No. So the gain over here, they are saying that the instrument is carried through other comprehensive income. So if there is a fair value gain on a financial asset or on a financial instrument and it is carried through other comprehensive income, where would the gain go? It will go to other comprehensive income, isn't it? Okay. And the other comprehensive income, all the accumulated gain on the other comprehensive income will be sent to other components of equity. So we go to the other component of equity and we eliminate that particular gain from it. So we come to the reversal of what? The fair value gain. Okay. And that will be 55 minus 50. So we go and eliminate it over here. Eliminating means that we are going to be what? Taking it away. The gain should not be in the other component of equity in the first place. There should not be, that particular investment should not be carried through other comprehensive income. So we go and eliminate that particular 5 that was recognized in their statement of financial position, which would be the other component of equity. So let's take the other adjustment before we move on to the net asset for that particular company. Okay. They say that a dividend received from Hill on 1st January 2012 of 2 million has similarly been credited to what? OCI. If you are receiving a dividend from the subsidiary, where would the dividend supposed to go? Is it supposed to go to OCI or supposed to go where? if you are receiving a dividend from the subsidiary, where would it? Is it going to be retained earnings or OCI?
Retain it.
Retained earnings.
So what we do is that we go and transfer the dividends over here. Dividends are supposed not to come here. So we transfer the dividends of 2 million from here. Then we now bring it towards the retained earnings of 2. Okay. So those necessary adjustments has been done now. Okay. The next thing is that we have to prepare the net asset table for them. Okay. So at the date of acquisition, yes, please.
The 5 million reversal of the fair value gain.
Yeah.
Are we not going to subtract it from the what's the name? Other components of equity from the statement of financial position?
Now we are not bringing the 55. So we have used the 50 already. It should have been 50 at the investment at the purchase consideration. Then you go and subtract the 5. But we are using the 50 already. So it means that we are crediting the investment with 5. That is why we are using 50 for the purchase consideration. All right.
Okay.
Okay. So let's count their net assets for the first subsidiary. Let's go to their net assets. What would be their equity value at acquisition? What would be their ordinary shares at acquisition? For the first subsidiary.
The two of them. So
Sorry?
it's 20.
Okay, that will be 20. Please, for equity shares, we want the parent to maintain the same shareholding, so there will not be any additional issue of shares. So the value at acquisition will be the same as what? The value at reporting. So that will be 20 million. 20 million. Let's count to their retained earnings. What is the retained earnings given to us?
27.
No, their retained earnings at acquisition is what? Okay, reporting is 27. Okay, but acquisition they have given us that at acquisition.
16.
Okay, that will be 16. Do they have other components of equity? Do they have other components of equity? No, none of them. Okay, so let's come here. What is the value that they are giving to you as a net asset? What is their net assets? At acquisition, what is the value of their net assets?
60.
Okay, but what's from their books, what should have been the net assets? What should have been the value of their net assets from the books? What would have been the value of their net assets from their statement of financial position? What's supposed to be the value of their net assets?
36.
Okay, 36. But they are now saying that it is what? They say their net asset is what? Is 60.
60.
Okay, what is the difference there?
24.
And what are they saying is the difference?
So it should be
They say the excess of the fair value of the net assets is due to increase in the value of what? No, land.
Undepreciable land.
It means that the date of acquisition, their land value has increased by what? 24. That is a fair value adjustment. So you calculate the question for corporate reporting. It is likely that they always give you the net asset value at acquisition. So you have to calculate the net asset the way that you know it. You add the equity item at acquisition. Then you now see your supposed net asset value compare with the one given to you. The question will tell you that the difference is due to what? A depreciable plant or anything. That is a fair value increase at the date of acquisition. So the fair value increase is 24 over here. So there is a fair value increase which is due to land. That will be 24, both at acquisition and both at reporting. This particular land adjustment has it been taken into consideration in the consolidated statement of financial position? The fair value increase. So what do we go and do? What are we going to be doing?
You add the 26 to PPE,
Okay,
and
it's,
then less the depreciation.
no, it's land, not depreciable land. So
Oh, sorry.
we don't have issue with the depreciation there. Okay. So from this place, what can you do? After knowing that, can we go and calculate the goodwill for them? Can we go and calculate the goodwill for Hill? Because there's no other issues that will come at acquisition again. So our goodwill for them will be 5 million. So that will be the goodwill at acquisition. We're done with the first part. Goodwill at acquisition. So we have 50 plus 15. That will give you 65. Then our net assets is 60. There's a goodwill of what? 5 million. Okay. So there is no other issues that will come at the acquisition date because they have given you the net asset at acquisition already. That is the net asset value. They have done a calculation. They have added what? The fair value increase, and they have given you 60 as a net asset at acquisition. So you have to come and know the increase that is in the land. You have to come and determine that. How do you determine that? You look for the what? The supposed net assets with your normal calculation. The share capital at acquisition, the retained earnings at acquisition, the other component at acquisition. Then you compare with the what? The figure that you should have what? Be having with the what? The net asset figure given to you by the question. The difference over there will be a non-depreciable or a depreciable item. Yes, I saw a hand up. Someone's hand is up. Senior Justice.
Yes, sir. Good
Yeah.
morning, sir.
Yes, Senior.
Please, sorry for taking you back. Where did we get the 36?
It is their share capital plus the retained earnings at acquisition. 20 and 30, 20 and 16.
Oh, okay. Okay, thank you, sir.
Okay, so for the A there, you are done with the E. I saw a hand up.
Hello, sir.
Yes, please.
And please let me take you back a bit. The group retained earnings. We added the
Take me back to where?
group retained earnings.
I'm in my room.
We pardon?
Maybe coming there.
Yeah, Steph, can you talk?
We added the dividend received, and I don't understand because I thought dividends from subsidiaries are not supposed to be recorded because
We add what?
we added the dividend received of
To
2 million.
2 million
Pardon?
to group retained earnings.
Yes, please.
It's supposed not to be what? You say it's supposed not to be what?
I thought dividends from subsidiaries are not supposed to be included in the group retained earnings. So I'm a bit confused.
Why? You thought why? Dividend is paid out of what? Profit, isn't it?
Yes.
Okay. Okay. If dividend is paid out of profit, okay. The retained earnings that the subsidiary is having over here is after what? Is after paying the dividend, isn't it? Okay. The profit that you are going to have at the post-acquisition profit will always be after dividend has been paid because we are taking the question from, we are taking the retained earnings from their statement of financial position. That is after dividend has been deducted. Okay. If the parent share of the dividends, what is the parent share of the dividends? Is 2 million, isn't it?
Yeah.
Okay. So it means that our total dividend declared or the total dividend paid will be calculated like this. Okay. Total dividend declared will be calculated like this. So we have 2 divided by 0.8. Do you agree? We have paid a dividend and the parent is taking 2 out of it. So it will be 0.8 multiplied by the dividend is equal to 2. Okay. What are you having as a total dividend?
2.5.
Okay. So if it is 2.5, it means that the actual profit made would have been maybe 27 plus 2.5 minus what? 16, which is the retained earnings at acquisition. Okay. But if we are having a share of the profit before dividend, it means that the dividend is included in the what? In the profit. So we don't have to consolidate, we have to remove. But the only thing is that the goodwill, or I say goodwill, the dividend that will be coming, the dividend cannot go to what? It cannot go to profit or loss. No. It's a dividend that they are paying to the shareholders. So that should be taken to what? Statement of changes in equity. But what happened is that if you are doing statement of changes in equity, you are going to be doing it for the parent, which the subsidiary is part of it. So the parent will receive the dividend as an income, and the subsidiary will still pay that particular dividend as an expense. So it will cancel. That is why we don't consolidate. But the dividend will be in the retained earnings of the parent. Why? Because the dividend is part of the profit. The total share of the profit should have been the dividend plus the profit that they have in the retained earnings. So if you are now paying part of the profit as dividends and also the profit after the dividend, if you put the two together, that will be your share of the profit for the year. All right. So we don't consolidate in the statement of changes in equity because of the parent having it as income, the subsidiary having it as what? As I expense. So it will just cancel out. All right. Stephanie, has your thought changed?
Yes, please. Thank you.
Okay. So let's go to the B. So we have done with the okay. Let's come to the B side then. Let me check what is happening here and see. Okay. Maybe we can finish it. So no problem. Let's move on to the B. All right. Someone should take the B for us. Stephanie, take the B for us.
On 1st June 2009, Robbie acquired 5% of the ordinary shares of Zinc. Robbie had treated this investment at face value through profit or loss in the financial statements to 31st May 2011. On 1st December 2011, Robbie acquired a further 55% of the ordinary shares of Zinc and gained control of the company. The consideration for the acquisitions were as follows. Shareholding and consideration. 1st June 2009, 5%. Consideration, $2 million. 1st December 2011, shareholding 55%. Consideration, $60 million. Total shareholding 60%. Total consideration, $80 million. At 1st December 2011, the fair value of the equity interest in Zinc held by Robbie before the business combination was $5 million. It is Robbie's policy to measure the non-controlling interest at fair value, and this was $9 million on 1st December 2011. The fair value of the identifiable net assets at 1st December 2011 of Zinc was $26 million, and the retained earnings were $50 million. The excess of the fair value of the net assets is due to an increase in the value of property, plant, and equipment, which was provisional pending receipt of the final valuations. These valuations were received on 1st March 2012 and resulted in an additional increase of $3 million in the fair value of PPE at the date of acquisition. This increase does not affect the fair value of the non-controlling interest at acquisition. PPE is to be depreciated on a straight line basis over a remaining period of 5 years.
Okay. Okay. So when when did Ruby obtain control over Zinc? When was control achieved?
1st December.
1st December. So we start consolidating from 1st December. Okay.
Yeah.
Now, what was the what? They say that the consideration paid for the 5%, which was on 1st June, is 2 million, isn't it? Okay. So they have now paid additional 16. So in the statement of financial position of Ruby, the investment in Zinc should be this figure. Let's go and check that figure. The investment should have been 18 million. But how much do we have here?
19. We have 19.
So what is happening there? There's addition of one.
Yes.
Okay. That one is relating to what?
Fair value.
Okay.
Fair value gain.
The one that you just the additional purchase will still be at their cost, which is 16 million. But the question says that the 5% we are carrying it through profit or loss, isn't it? Okay. It means that before the acquisition of the additional shares, we have already recognized 1 million gain on this particular item. That's why we are having a 19 million. Okay. So it means that in the statement of financial position, the 5% investment is 3 million. Do we agree?
Yes, sir.
Okay. At 31 December, the fair value of the equity interest in Zinc held by Ruby before the business combination was what? At the date of control now, our 5% now is having a fair value of what? Please, can you hear me?
Yeah.
Okay. So they are saying that at the date of the business combination, before we acquire the 55% additional shares, the investment for all the 5% investment is now having a fair value of what?
5.
So what will be the increase in that value?
2.
Okay. So that too should be taken to retain earnings, group retain earnings as a gain on the what? So we have the fair value gain. So you have 5% one. So maybe the 5%, you can just do your 5 minus 3. So that will be 2 here. Okay. Let's come to, oh no.
Hello, sir.
The group retain earnings. Yes, please.
Hello, sir. Can you please come over with the fair value gain?
Okay.
Because the line was breaking. I didn't hear you.
Okay. So we have the fair value for the 5%. That will be 5 minus 3. And that will give us 2 to be taken to group retain earnings, not that. All right. So yes, the question is giving you the consideration paid. Okay. The 5%, we purchased the 5% for 2 million. And additional shares is 16 million. So our investment in Zinc should be 18 million. Okay. But the figure that we have over there is 19 million. Okay. The figure that we have over there is 19 million. Okay. So the investment in Zinc is 19 million. We should have been 18 million. You can see that there is an increase of 1 million. That particular increase of 1 million is as a result of what? The fair value increase in the what? In the 5%. So it means that the 5% has increased by 1 million. So this will be 3 million and 16 million. That will give us 19. So the value of the 5% in the statement of financial position for Ruby is 3 million. But the question is saying that at the date of acquiring the additional what? 55%, the fair value of that particular instrument is now 5 million. It means that there is a further increase of 2 million. So that 2 million is the gain on the what? On the remeasurement of the previously held what? Investment. That is the 2 million, which will be taken to group retain earnings immediately. All right. So what will be our total purchase consideration for zinc, what will be the total purchase consideration for zinc? What will be the total purchase consideration?
21.
Okay, that will be 21. It will be the 5, which is the new value plus that. So let's come to the goodwill for zinc. We calculate the goodwill for zinc over here. So goodwill for zinc. So we have our purchase consideration. Our purchase consideration. Our purchase consideration will be the 5%. If you like, you can split it. 5% will be 5 million. 55% will be 16 million. So let me just put 5 plus 16 over here. Then we have 21. Okay. Are we giving information on the non-controlling interest?
Yes, please.
Okay. So the non-controlling interest, what you do is that we are going to do so you can just count to non-controlling interest here, the fair value. Okay, the first one is held. So we count to zinc here. That is 9 million, isn't it? Okay. So we still have the non-controlling interest over here under the goodwill calculation. We add it. Okay. Then we have the 9. So the total will now give us 30 million. Okay. So we now go to the other issues about them. Okay. The fair value of the identifiable net assets at the date of control, which is the 1st December 2011 of zinc, was 26 million. And the retained earnings were what? 15 million. The excess of the fair value of the net asset is due to an increase in the value of property, plant, and equipment, which was provisional pending the receipt of the final valuations. These valuations were received 1st March and resulted in additional increase of 3 million in the fair value of PPE at the date of acquisition. This increase does not affect the fair value of the non-controlling interest at acquisition. PPE is to be depreciated on a straight line basis over a remaining period of 5 years. Okay. Is if you count to consolidation, we call something measurement period. Measurement what? Period. What do we call measurement period? You see, at the date of acquisition, the standard says that all the assets and liabilities of the investee or the subsidiary should be fair valued. So sometimes the fair value measurement will not be available. So the question is going to give you, or the standard has given you a period, which we call the measurement period. And within that particular period, you will now be what? Measuring what? You will be carrying out exercises to determine the fair value of certain items. Okay, so you'll be getting, maybe the valuers will give you, okay, since you want to do your consolidation, we are going to give you a value now. That is the value, but we still continue with the valuation. We still continue with the valuation. Okay, so maybe before the year ends, they are going to give you a final valuation now. This final valuation is relating to an item at acquisition. So you just treat the additional valuation as if it was there at acquisition. So they will give you, the question will say that, okay, they receive a provisional amount pending this one. So whenever the valuation is being received, you'll be added it to acquisition because we are doing the valuation for an item that's happened at acquisition date. So the valuation that we have over there is just a pending value. So they will determine the final value and give it to you. Then you go and add it to acquisition. You take the final valuation as if it has been given to you at the date of acquisition. So the standard, we call something measurement period. Within that period, it is a period allowed for what? For the entity to determine the fair value of all the assets. So whenever the fair value is being determined or the final valuation is being determined, you add it to the pen or the provisional value at the acquisition date. Okay, so we do the calculation for that to determine the value, the pending value or the provisional value. Then we come and add the 3 million to it. So let's do the net asset for the other people too. So let's count to their net assets. Okay, so let's count to the net asset for, so the net asset for zinc. Okay, so we have at acquisition, at reporting. Okay, what is their ordinary shares? What is the ordinary shares of the ordinary shares is what? Zinc.
10.
10 million.
Okay, that will be 10 million, both at acquisition and at reporting. So we have 10 million, 10 million. So they are retained earnings. The question has given us a retained earnings at acquisition. So what is the retained earnings value there? So reporting is 19. Let's go to acquisition. I'm sure acquisition is 3 million or something. It's 16 million or something. Okay. The value of the net asset at 31 December was 26 million. The retained earnings. The excess of the fair value of the net asset is due to increase in property, which was provisional pending the receipt of the final valuation. So the retained earnings is 15 million at, so 15 million, and this was 19 million. Okay. The question is, at the date of acquisition, what is the net asset value that they are giving to us? What was the net asset value at the date of acquisition? 1st December 2011.
26.
Okay. But what's supposed to be the what? What's supposed to be the value? All things
25.
that should have been 25, isn't it? Okay. So it means that the increase is what?
1.
1. Okay. But they say that is a provisional what? Amount. That is a provisional amount. So the PP will be 1. Okay, that is a provisional value. But our final valuation has been received. Okay, let's come here. These valuation were received on 1st March 2012 and resulted in an additional increase of 3 million in the fair value. So if the provision, if the final valuation is received before the reporting period, that should be treated as part of the value at acquisition. But if it should be received after the acquisition period, then that will not be any issue. You don't have to go and make adjustment to your to your goodwill again. But whatever you have to know is that we have what we call measurement period. It's a period that it is been allowed for for the acquirer to determine the fair value of of the assets. So the fair value of the assets will be received before the reporting date. That value should be treated as if it has been there because it is relating to the assets. It's not it's not a revaluation, no. That is a date that the fair value has been determined. And they say this resulted in an additional increase of 3 million. Okay. So it means that our net assets should have been 29 million. So we come here and add the 3 million over here. So this will be 4 million. This will be 4 million. Then we come to depreciation over there. Okay. So let's count to depreciation will be at reporting. All right. So let's look at the question there and see. All right. Okay. So our fair value of the property, plant, and equipment is 4 million at the date of acquisition, not 1 million, because the pending or the final valuation will be added to what? To the provisional value at acquisition. It will be treated at acquisition, measurement period. Okay. The PP at acquisition now is 4 million. Okay. When are we reporting? What is our reporting date? What is our reporting date?
31st May.
Okay, so from December to May, 1st December to May, how many months is that?
6 months.
So we depreciate this particular asset by 6 months. So we have, this will be 4 over 5, which is the useful life, multiplied by 6 over 12. What are we having? So I'll come here and add the 4.
53.
That will be
53. Oh,
right?
sorry.
I'm having 0.4.
Yeah, 0.4.
0.4.
Okay, so that 0.4 will be treated as what? Reporting, it's a depreciation. Okay, so the asset, the PP will increase by 4 million. I've added that already, but we come and take our our depreciation of 0.4 million from it. Okay, so that is that for that particular side also. Okay, so let's go and determine the goodwill for them, because at acquisition, no issue will come at acquisition for them again. So we have the acquisition figure will now be 29 million. So we come here, we have the goodwill. So we have the net asset for them, and their net asset for them now will be 29 million. What will be the goodwill for them?
That should be 1.
Okay. Okay. So we don't have to do anything. Let's go and what is for, okay, let's come to the C. C, what is going to happen under the C there? C. Can someone take the C for us?
Robbie has a 40% share of a joint operation, a natural gas station. Assets, liabilities, revenue, and costs are apportioned on the basis of shareholding. The following information relates to the joint arrangement activities. The natural gas station cost $15 million to construct and was completed on 1st June 2011 and is to be dismantled at the end of its life of 10 years. The present value of this dismantling cost to the joint arrangement at 1st June 2011, using a discount rate of 5%, was 2 million. In the year, gas with a direct cost of 60 million was sold for 20 million. Additionally, the joint arrangement incurred operating cost of 0.5 million during the year. Robbie has only contributed and accounted for its share of the construction cost, paying 6 million. The revenue and costs are receivable and payable by the other joint operator who settles amount outstanding with Robbie after the year end.
Thank you. So this is what? Joint operation under IFRS 11. So the question is telling you that each of the party to the joint operation, they have the right to the assets, liabilities, and also the revenue and the cost. So yes, we have done joint operation, we have done joint arrangement that was last Saturday, and we said that what is going to happen is that we use what we call partial consolidation. So you find your portion of the asset that we are bringing in, you find a portion of the asset. So let's come to the Ruby share of the asset. That will be 0.4 multiplied by what? 15 million, which is the cost. Okay. How much are you getting?
$6 million.
Okay. So go to the joint operation there and see whether it is the 6 million that they have over there. The jointly controlled
It's
operation.
6 million.
So that is why they are saying that he only accounted for what? The share of the assets. Okay. But what is going to happen is that we need to go find a share of what? Ruby's what? Revenue, the cost of sales, to determine his what? His profit from the operation. Okay. So we are going to use so many ways of doing this. Okay. You pick the one that you like. All right. Let's come to the joint arrangement. So let me put 6 here, which will be the joint operation. Okay. So the joint operation, the first one is that the share of the what? The assets. So we have the assets. Okay. The asset will be 0.4 multiplied by what? 15 million, isn't it? Okay. Okay. Let's come to the share of the provision. The dismantling cost. What is the total cost that we are going to incur to what? To dismantle the property at the end of the 10 years. How much is that? What is the present value of that?
0.5.
Okay. It's 2 million, isn't it? So 40% of the 2 million is what? 0.4 multiplied by 2 million. What are we getting?
0.8.
Okay. So we have 0.8. How do we account for provision, dismantling cost? It should be added to the PPE first. Then we what? We now keep the provision, isn't it?
Yes.
Okay. So let's count the value of the assets. So the value of the asset. Last time that we were doing this one, I didn't add the provision because I was watching the Madrid match together with the teaching. So my mind is not really there. Okay. So the provision should be added to. So we have the assets, which will be 6 million. Then we add a provision, which is the present value of what? The dismantling cost. That is how we do it. So we have 0.68. So the total value of the asset will now be 6.8. Okay. So after doing this, you just go to their statement of financial position and adjust this before we move on. So we have non-current liabilities. You come and add 0.8, which is a provision. Provision has not been taken into consideration. You count the jointly operate this one, you add a provision now to make it 6.8. Okay. So what will happen? The asset will be used for how many years? The asset will be used for how many years? How many years are they going to use the asset?
10 years.
Okay, so it means that let's look at when are we doing this? The arrangement was done on what? 1st June 2011. It means that is a full year. June 11 to 31 May 2012 is a full year. So that will depreciate. We depreciate the assets. So that will be 6.8 divided by 10. What are we having as a depreciation? 0.68. Is that correct?
Yes.
Okay.
Yes.
Let's count to the finance cost on the what? The finance cost on the provision. So let's go to the rate. We have to unwind the provision at the end of the year. So the rate is 5%. So we unwind our portion of that. So that will be 0.05 multiplied by 0.8. What are we having as a finance cost?
Zero 0.04.
Okay. So we now have 0.04. Okay. Depreciation will be subtracted from the assets, but the provision we are going to add 0.04. It will increase by the finance cost. Okay. So this will be, we subtracted 0.68 from this one as a depreciation. Okay. But the two, don't worry, you can take these two, the depreciation and the finance cost to the retained earnings, but I want to write it against what? The profit for the year. I want to write it against the profit from the joint operation. Okay, so let's count to the profit from the joint operation. The profit from the joint operation. Okay, the profit from the joint operation. So we have the revenue, which these people, they are going to find their share of the revenue. So 0.4 multiplied by the total revenue for the year. What is the revenue? What is the revenue there? In the year, gas with direct cost of 16 million was sold for what? 20 million.
20 million.
So the revenue is 20 million. So our share of the 20 million, how much are we taking?
8 million.
Okay. So 8 million. We also take the share of cost of sales. So the cost of sales will be 0.4 multiplied by 16. Okay. If you like, you can find the profits separately and what? And find their share of the profit. It's the same thing that you'll be getting. So 0.4 times 16, what are we getting?
6.4.
Okay. 6.4. So what would be the gross profit? Okay. The gross profit.
1.6.
Okay, that will be 1.6. Then we count to operating expenses. You can see that we have the operating expenses there. So these particular people, they incurred an operating expense of what? Of 0.5. So we also have the share of the operating expenses, 0.4 multiplied by 0.5. Multiplied by 0.5. What are we having?
0.2.
Okay. So we have 0.02. Okay, but what is happening? We are having a depreciation relating to the what? To the joint operation. We are having finance costs. So you can bring all of them over here to know your actual profits. So let's bring the depreciation.
Brian, I got 0.2.
0.2, okay. 0.2. So we are having, so the depreciation and the finance cost, they are all relating to what? To the joint operation. So we can net them against what? The profit that we are going to be getting there. So we have a depreciation figure of 0.68. Then you have the finance cost of 0.04. Okay, what will be the total profit that they will be receiving? What will be the profit that they will be receiving? 1.6 minus 0.2 minus 0.68 minus 0.04. I'm getting 0.68.
Yes, please.
Okay. So this 0.68 now will be their share of the profit. So we have their share of the profit that will go to their retained earnings. Okay. That will be the share of the profit to retained earnings. Okay. I'm saying that you can also do this like this. You bring the revenue, you bring the cost of sales, you find your this one, then you bring your operating expenses. So you find a profit relating to the joint operation before they will find 40% of it. You should be getting the same figure up to this level as a 1.4. Then you take your expenses that are related, which is the depreciation and the finance cost. You will be getting the same figure. All right. So what we do over here is that this particular profit should be sent to their group retained earnings. So you have the joint operation to be working 6. So that will be 0.68. Okay. Let's go to the other side of the question now. Okay. Ruby has only contributed and accounted for each share of the construction cost, paying 6 million. The revenue and costs are receivable and payable by the other joint operator who settle amount outstanding with Ruby after the year end. Okay, let's come here. For this one, okay, these ones, they say we only receive the revenue and these ones are payable after the year end. It means that all these transactions, all these sales that we have now, the sales is on credit. The cost, we haven't paid anything. The cost, we haven't paid anything. So what we do is that, what is the portion? If this should be for cash, what is the portion are we going to be receiving from the revenue as cash? If the 20 million should be on cash basis, what is the what? What is the portion that we are going to be receiving from them as cash?
That is the 8 million.
Okay. So, but this is on what? This is on credit basis. So we have to receive 8 million from this. So we are going to have a receivables, which is 0.2, 0.4 multiplied by this, because we are here to receive our share of what? Of the revenue. So that will be receivables, 0.4 multiplied by the 20. That will give you receivables. Okay, let's come here. What is the total cost incurred? What is the total cost incurred by
16.5.
Okay, 16.5. What will be our share of it? Okay, so it means that as we are receiving the revenue, we also have to pay for the cost that they have incurred. So we find our share of the what? Of the revenue as receivables. We are here to receive our share of the revenue. Okay, and the cost too, we are here to pay them because we are doing this together. So the 16.5 will be shared among them, 40 against what? Against 60. So what is our portion for the 16.5? So you show their share of the revenue as receivables. You show the amount that is supposed to pay to the joint operation, or the amount that is supposed to contribute to the joint operation as a result of what? The operating activities. That will be the 16 million, which is the cost, and the operating expense, which is the cost. And that will give you the what? The 16.5 multiplied by the 0.4. So So you treat those two as payables. You can net them, there's no problem, but it should be shown as payables and receivables for the two. So we come here, the current liabilities, we now have 0.4 multiplied by that. What are you having?
6.
So 6.6. Okay. So you now have your current asset. We now have receivables of 8. You can net them. It can be 8 minus what? 6.6. Then you show only receivables of what? Of 1.4, which is the same as their cash profit over here. You can see that their cash profit over here is 1.4, which is 1.6 minus 0.2. But just that we are having profit as a result of additional expense that we are incurring, which is the depreciation and that one. That's why we have the 0.68 there. Okay. You can net it, that will be fine. But the standard says that we should show all of them one by one. You should show your share of the revenue or the cash, the share of the cost or the payables. You should show all of those ones in your statement of your financial position. All right. So, okay, this is one of the reasons that I've decided to do the joint arrangement. Okay. For the consolidation, they decide to set questions on some part of the consolidation. It will worry us, but how we would do it. So the joint, that is about a joint arrangement. You don't have to do any plenty things there. Let's look at the D and the E. Okay, D, E, F. Now we know that we are done. Okay. The D.
Robbie purchased PPE for 10 million on 1st June 2009. It has an expected useful life of 20 years and it is depreciated on the straight line method. On 31st May 2011, the PPE was revalued to 11 million. At 31st May 2012, impairment indicators triggered an impairment review of the PPE. The recoverable amount of the PPE was 7.8 million. The only accounting entry posted for the year to 31st May 2012 was to account for the depreciation based on the revalue amount as at 31st May 2011. Robbie's accounting policy is to make a transfer of the excess depreciation arising on the revaluation of PPE.
All right, thank you. So this is PPE together with what IS 36, that is impairment of non-current assets. Okay, they say Ruby purchased the asset on what? Ruby purchased PP for 10 million on 1st June 2009. It has an expected useful life of 20 years and depreciated on the straight line method. So on 31 May 2011, the PP was revalued to 11 million. So how many years after the purchase before the revaluation? How many years? The purchase was 1st June 2009.
2 years.
So that
2
was
years.
So we need to determine the carrying value of the PPE at that date. So let's count to maybe working 7. So we look at the revaluation of the PPE. Revaluation of PPE. So what we do is that at the date of the revaluation, which is 31 May 2011, 31 May 2011, you need to determine the carrying value of the asset. So what is the carrying value of the asset in our books? That will be the cost of 10 million minus into brackets accumulated depreciation of what? That will be 10 million divided by, what is the useful life?
20.
Okay. So that will be 10 over 20 multiplied by what?
2.
Okay. Would the multiply by 2 be relevant here? Because we have done 2 years already. So the accumulated depreciation should be 2 years. 10 over 20 is just a year. So if you want to get a 2 years, you have to put that particular depreciation together. So we have the carrying value to be equal to 10 minus what? Would that be 1? Okay. So we have carrying value to be 9, isn't it? Okay. So we have to now have our revalued amount. Okay. Our revalued amount is 11 million. Are we having a surplus or we are having a loss?
That's a surplus.
Okay. We have a revaluation surplus of 11 million minus 9 million. That will give us 2 million. Is that correct? Okay. That has been accounted for already. Our business over here is to look for the impairment loss. Okay, that has been accounted for already. So at 31 May 2012, impairment indicators triggered an impairment review of the PPE. The recoverable amount of the PPE was 7.8 million. The only accounting entry posted for the year to 31 May 2012 was to account for the depreciation based on the revalued amount as at 31 May 2011. Ruby's accounting policy is to make a transfer of the excess depreciation arising on the revaluation of PPE. So the question now is, after a year, the revaluation was done on 31 May. After a year, we need to carry out an impairment test on the assets. So when are we carrying out the impairment test? It's at the end of the year, which is 31 May 2012. So, but the 11 million that we have over here, the 11 million we have over here is from 31 May, or is on 31 May 2011. So we need to know the carrying value as 31 May 2012 so that we know whether the asset has impaired or not. So the carrying value will be our 11 million, which is now the new value of the asset. Whenever an asset is being valued, the revalued amount becomes the new value of the asset. That will be 11 million. What will be the depreciation now? How are we going to calculate the depreciation now? Depreciation will be for only a year. And what will be the depreciation value? It will be what?
0.61.
How did we get a 0.61?
11 divided by 18 years.
Okay. So the total useful life of the asset is 20 years. We have used 2 years already before we revalued. So the new revalued amount, which is 11 now, will be used for the remaining useful life, which is 18 years. So our depreciation will be 11 divided by the 18. So our carrying value will be 11 minus what? 0. What? 11.
6.
Okay, let's make it 0.6. Okay. What will be our carrying value?
10.4.
Okay, 10.4. What is the recoverable amount given to us?
$7.8.
Okay. So what is the impairment loss?
Two, 2.6.
2.6.
2.6.
Okay. This 2.6, you can't just stand up and send it to profit or loss. The asset was first revalued, and we have a revaluation surplus of what? 2 million, isn't it? Okay. Now they are saying that there's a revaluation, there is a loss, which is technical revaluation loss of what? 2.6. It means that we have to go and write off the first what? The first surplus that we have. The loss should be taken to the what? To the OCI first, so that we can cancel that particular portion of the gain relating to that particular asset in the OCI. Then the remaining one will be taken to profit or loss. But let's come here. The question says something over here. Okay. The question says something over here. They say that Ruby's accounting policy is to make a transfer for the excess depreciation arising on the revaluation of PPE. Okay, this is just very simple. Let's come here. Without the revaluation, what was our annual depreciation? Without the revaluation, our annual depreciation was 10 divided by 20, isn't it? Okay, that will give us 0.5. Is that correct? Without the revaluation, our depreciation every year should be the
0.5.
0.5. But what is the depreciation after the revaluation now? What is the
Zero
other?
point six.
0.6.
Okay. What is happening to the depreciation there?
It's increasing.
Okay. By how much?
0.1.
Okay. So 0.6. Okay. What is bringing the 0.1?
Is the revaluation.
Okay. But what we do is that the depreciation that's supposed to go to profit or loss, it should be the 0.5. And the 0.1 should be a depreciation charge against OCI. Because this 0.1 is a depreciation that is coming in as a result of the revaluation, which can also be calculated as the 2, which is the revaluation, divided by 18. You'll be getting 0.1. It will be 0.9, but if you approximate, it will be 0.1. Okay, so it means that the actual depreciation that should go to profit or loss should have been 0.5, but we are sending what? 0.6. It means that we are understating our profit by 0.1 because the 0.1 supposed not to go to profit or loss. It's supposed to be charged against OCI. Okay, but we are taking a value that's supposed to go to SCI to reduce the revaluation surplus, but we are taking it to profit or loss. How do we correct this particular mistake now? At the end of the day, we need to go and transfer the 0.1 excess depreciation or the depreciation caused by the revaluation to retain earnings so that we can cancel the effect of the depreciation on the revaluation surplus in the profit. That is why they say that every year they will do an annual transfer. They want to eliminate the depreciation effect on the profit caused by the revaluation. So the depreciation should have been 0.5 to profit or loss, but we are taking 0.6. We are taking the normal depreciation together with the depreciation on the revaluation surplus. So the revaluation surplus depreciation should be charged against the revaluation surplus, but we don't do that. So we have to transfer that effect from the revaluation surplus to retain earnings so that we can neutralize the effect of the additional depreciation. So the company will transfer 0.1 for this year to retain earnings. So it means that the revaluation surplus will no longer be be 2 million in the OCI or in the revaluation surplus account or in the other component of equity. It will be 2 million minus the figure that we have transferred, and there will now be 1.9. Okay, so we have a revaluation surplus. We now have a revaluation surplus of 1.9 because we have transferred 1.9 to what? We have transferred 0.1 to retain earnings. It will be left with what? 1.9. Or we can say that we have depreciated the 2 million by 1 year. So it's left with what? 17 years. And that 17 years will be 1.9. That is the figure that we are going to be having in the other component of equity, which is the revaluation surplus. Okay, so we now have impairment loss of 2.6. So this impairment loss will be shared like this. 1.9 will be taken to the revaluation surplus to remove the revaluation surplus, which is in the other component of equity. Then you count to the remaining one. What will be the difference? 2.6, and you are taking 1.9 from it. What will be the difference?
0.7.
Okay, that will be 0.7. So we now have profit or loss, which will be retained earnings because we are doing. So we have retained earnings to be what? 0.7. So in total, your impairment loss will be 2.6. Okay. The impairment loss has not been accounted for. So let's come to our group retained earnings. We have the impairment loss, the portion that is coming here. We have the impairment loss of 0.7. That will be coming here. Then we have the impairment loss in the other component of equity, which will be 1.9. So impairment loss of 1.9. Okay, has the impairment been adjusted against the PPE? Based on the information given to us, the impairment has not been accounted for, isn't it?
Yes.
So it means that we have to go and reduce our assets to 7.8. So impairment loss of 2.6 will be taken from the PPE now, because included in the PPE, they are having 10.4, which is a carrying value that we have calculated here. So what we do is that we will go and take the impairment loss from the carrying value of the asset because they haven't accounted for the impairment loss. The only thing that they have done is to depreciate the asset based on what? Based on a revalued amount. So they have 10.4 over there. They are saying that it is now 7.8. We go and what? Take the impairment loss from that figure. Okay. Let's go to the B, the E rather. The E. What are we having there?
Robbie held a portfolio of trade receivables with a carrying amount of 4 million at 31st May 2012. At that date, the entity entered into a factoring agreement with a bank whereby it transfers the receivables in exchange for 3.6 million in cash. Robbie has agreed to reimburse the factor for any shortfall between the amount collected and 3.6 million. Once the receivables have been collected, any amount above 3.6 million, less interest on this amount will be repaid to Robbie. Robbie has still recognized the receivables and charged 0.4 million as a loss to profit or loss.
Okay, this is factoring, isn't it? Okay.
Yes.
So another financial instrument, we spoke about factoring without a recourse and factoring with a recourse. What you have to know is that, the treatment, one will be under the, without a recourse, the company will recognize bad debts, and we have explained that. And other, without a recourse, bad debt will be recognized. And with a recourse, the company will treat the amounts taken as a loan, and the receivables will still be in the books. What you have to ask yourself is that, who bears the majority of the bad debts? If the people are not able to pay, who is going to bear the bad debts? If the people are not able to pay or to settle their debt, who is going to take the bad debt back? From this question, it is a company, isn't it? Okay. This is a factoring with a recourse. The factoring without a recourse is that the entity will sell the receivables to what? The factoring company or the factor, and that will be the final payment. The question will say that is a final payment. That is a final payment. Any amount, if the factor or the factoring company is able to receive any amount in excess of the amount given, no disbursements will be given to you. If the customers are not able to pay, the factoring company has no right for the money that, or to ask the company to return the advancement given to them. In that case, you see that the bad debt is being passed on to the factor. So what will happen is that we are selling, or we are collecting only 3.6 from our receivable. So the remaining 0.4 will not be collected. The situation where the question will be telling you that if the people are not able to pay, the factoring company has the right to return the receivables to the company and ask the company to pay the amount given to them plus interest. It means that you are just telling that person that, okay, I have receivables, but I don't have money. So give me some money. Try to see if you can collect the money for me. If you're not able to collect it, come for your money plus interest. It means that you are using the receivables to take loan. So the question will make it clear for you. They will give you information to know that this is factoring without a recourse, and this is a factoring with recourse. So you know how you should treat it. This particular situation, if the money is not being collected, the amount will be given back to Ruby. So it means that whatever happens at the end of the period, Ruby will take back the receivable. So Ruby will bear the bad debt as a result of inability to collect the debt. Ruby has the right to additional consideration if they have, or if the factor is able to collect all the money. But if it is factoring without a recourse, whether I'm able to collect all the money, I will not give you anything again. But factoring with a recourse, the entity will have the right to additional cash flows if the money, or if they are able to collect the money within a specified period. And the factoring company has a right to return the receivables back to you, take their money together with interest. If that is the case, you treat the amount that you are receiving from those people as a loan. You are not selling the receivables to them because they will bring the receivables back to you. So you are just using the receivables to take a loan. So, but the receivables should still be in the books. The receivables should still be in the books. No bad debt should be what? Should be recognized. So we have to go and reverse this transaction. Okay. They are saying that the receivables has been what? De-recognized. How much is the receivables? How much was the receivables?
4 million.
Okay. So what we do is that we go back now and what? I bring the receivables back to the books. So you don't have to recognize that. So you go here and add your 4 million back. Okay. They have recognized bad debt. The bad debt will be charged against profit or loss, isn't it? So what will happen is that the bad debt should not be recognized. So we have to come and what? Reverse the bad debt. It was charged as an expense. So reversing it means that we'll be adding it back. Okay. So let me just use the double entry for you over here. You debit current account with the receivables. Okay, you debit current account with the receivables, current asset with the receivables of 4 million. That means you are bringing the receivables back to the book. You're supposed not to de-recognize the receivables because the people will still bring the money back to you. So you are taking loan. You are not selling the receivables. Then you now credit your retained earnings to reverse your what? Your bad debts. And that will be 0.4. Okay. Then you will now treat the cash that you receive as a loan. So you credit loan. So you credit loan or you credit current liabilities depending on the duration with the 3.6. So we have done the receivables, we have done the what? The retained earnings. We are going to be bringing the cash now as a loan depending on the duration of the arrangement. So we have current liabilities now to be 3.6, okay, as the loan that you are taking. So you always have to pay attention to the arrangements. The question will tell you that the amount that the company is receiving is the first and the final settlement. Any amount that is, if the factoring company is not able to receive the money, it's none of your business. So it means that you are selling your receivables for a fee. So it means that the remaining portion, you are not going to receive it. So you write it as a bad debt. So the question is, who suffers the risks of the bad debt? If you are not able to collect all the money, who suffers that particular risk? Is it the company or it is a factoring company? If it is a factoring company, that is a factory without a recourse. But if it is the company that suffers the what? The bad debt risks as a result of inability to collect the debt, then that is a factoring with a recourse. The amount received as an advance payment will be treated as a loan, not a settlement of the receivables. All right, let's go to the last one. Then we can now put your figures together. Okay, the F.
Immediately prior to the year end, Robbie sold land to a third party at a price of 60 million with an option to purchase the land back on 1st July 2012 for 60 million plus a premium of 3%. The market value of the land is 25 million on 31st May 2012, and the carrying amount was $12 million. Robbie is still in possession of the land. Robbie accounted for the sale, consequently eliminating the bank overdraft. At 31st May 2012, Robbie uses revaluation model to account for PPE.
Okay. So you see, this is, we call something a sell. Okay. So if you make a sell, sometimes the question will be telling you that, okay, the sell, what do you have to do? What do you have to do to measure the sell is that you ask yourself the value that you are selling the asset to the person. Okay, the value at which you are selling the value to the person. Is it higher than the current market value? If it is higher than the current market value, then, or it is the same as the current market value, that is a sell. But if you are selling the asset lower than the current market value, it means that is a financing arrangement. Okay, so you can, if you are selling to someone, if you are selling, you can't sell more than what? The market value of the asset. The two of you, you are rational about whatever you are going to be doing. So the value at which you should be selling the asset should be approximately the current fair value or the current market value of the asset. But situation where you are selling at a value lower than that current value, it is being deemed as what? You are using that particular property as a collateral security for a financing arrangement. But the question is the question has given us a lot of information to know that this is not so. Okay, let's come to you. That is just for this question. For this question, so let's come here. When do we recognize an item as a sale? When do we recognize a revenue? When do you recognize a revenue? You have sold to someone. The thing is not a biological asset. It's only biological asset that if you are a farmer, or maybe you are a poultry farmer, sometimes you sell a goat to somebody. The person will say that the goat should be with you for some time so that the person will come and take it. For biological assets, this one is allowable, where you sell and you still be in possession of the asset, because maybe the person does not have knowledge on how to go about the assets. Okay, but for normal assets, where you say that you are selling a car and you say that I should bring money so that you sell the car to me, I brought the money, but you are still using the car. It means that you haven't sold the car to me. You have taken the money from me to do something which you are going to pay back. Okay, so we only recognize a sale or revenue when possession and the risks associated with the asset or with the item has been passed on to the third party. But they are saying that Ruby is still in possession of the land. Ruby cannot recognize a sale on this particular transaction, because the third party is not in possession of the land. The land should be transferred to the third party. The risks associated with with the land, the ownership and everything with the land should be transferred to the third party. This is not a lease arrangement where you sell the land and you still lease it back to farm on it. No. The question does not give us enough information to make that assumption. So you are selling to a third party, not someone who is related to you. So after the sale, you should be able to give the land to the person. The person is not in possession of the land. So it means that the amount that you are receiving from the person will be treated as as a loan. Okay, but let's come to what they are saying here. So that will not be a sale. Okay, so Ruby is still in possession of the land. Ruby accounted for the sale, consequently eliminating the bank overdraft at 31 May 2012. Okay, the carrying value of the land is what? The carrying value of the land is what? 12 million, isn't it?
12 million.
And how much was the land sold for?
60 million.
Okay, so it means that Ruby has what? Ruby has recognized a profit on the sale of what?
4 million.
Okay, that profit should not be recognized. The profit will be sent to retained earnings, isn't it? Okay, so profit on disposal should be what? Should be reversed. So it was an income added. So we are now reversing now. We have to subtract it. Okay, what happened? The 16 million will be treated as what? The 16 million that they are receiving will be treated as what?
Go to cash.
But they have received their cash already. So that's why they have removed the bank overdrafts. Okay.
Alright.
So the 16 million will be treated as what? As a loan from what? From a third party. Okay. So they haven't given us when Ruby has the right to purchase the land back on 1st July for 2016. So maybe within that particular period, we can say that will be a current liability. So the current liability, okay. So we treat the loan as a current liability, which will be 16 million. Okay, what will happen? The asset has to be brought back to the books, isn't it? Okay, so the asset, they have taken 12 million. So what you do is that you have to reverse everything about this transaction. You have to reverse everything about this transaction. How do you reverse that? You now debit the asset back, which is a PPE with a 12 million. You have removed 12 million, bring it back. Okay, you now also debit what? Debit your retained earnings, because you have you entered a gain of 4 million. So you have to go and remove it by debiting. Okay. The next one will be, you are going to now bring in what? The liability, which is the loan. Okay, whatever will happen is that you are still going to receive the cash. So there will not be any problem with the cash. Whatever is coming in, whether it is a loan or it is a sale, the cash will still be received. So you now have the 16 million here as what? As that. So this is how you recognize this transaction. You have to reverse everything. So the asset will be brought back. The profit should not be that one. The cash, okay, the cash, someone can say that let's credit the cash because we are receiving cash. So you credit the cash, but you still receive the 16 million as a loan again. So you still debit your cash and still credit your liability. So the cash will be having zero effects. So let's just credit the liability as the 16 million. But the question says something about the question says something there. Let's come here. Ruby uses revaluation model to account for property, plants, and what? Equipment. Okay, so in our books, the property is now 12 million. Okay, but what is the market value of the property now?
That's 25 million.
So the value, we are using revaluation model. So at the end of the year, we revalue the property. So what will be the revaluation surplus there?
13.
Okay, so we go to our other component of equity. We have a revaluation surplus of 25 minus 12. That will give us 13. You go to your PPE, then you add your 13 to this place to now make it a 25. Okay, let's find our post-acquisition profit for them. So the net asset at acquisition for here will be 20 plus 16 plus 24. That will give us 60. So we have 60 over here. Let's count to their reporting figure, 20 plus 27 plus 24. I'm having 71. Okay. Post-acquisition profit will be 11. Is that correct? Okay. Total goodwill will be 6 million. So you count the goodwill over here, working is 3. You have your 6 million here. So financial assets. Hey, we didn't add the zinc figures.
See, the impairment won't it affect the goodwill?
No, there is no impairment on goodwill. The impairment is relating to only the assets. Please, we didn't add the values for zinc. So property, plant, and equipment will be 26. So that will be 26 for them. What is their financial asset? Zinc. Their financial assets is 14. So we have the 14 here. What is their current assets?
12.
Okay, current
12.
assets 12. Okay, so we have 12. Their non-current liability is what?
That's 21.
21. Okay, and their current liability
is 2.
So we have 21 and we have the 2 here. Okay, let's count to the post-acquisition profit is 11. Okay, so the share of the post-acquisition profit, that will be for here, NCR will be having 0.2. Is that correct?
Yes.
Okay, so 0.2 multiplied by 11. So we have 2.2 here. Let's count to the share of post-acquisition profit for zinc. Let's go and calculate that. Okay, the NCR will be having 40% there. Okay, so let's count to this one. Okay, what will be the share of the post-acquisition profit for them? That will be 19 minus 15 minus 0.4. I'm having 3.6. Would that be 3.6?
Yes, please, 3.6.
Okay. So NCA will have 40% because the parent is having 60% there. 0.4. I'm having 1.44. Okay. So let's just make it 1.0.4 multiplied by 3.6. 1.44. So you can put the NCA together now. The parent share of the post-acquisition profit for here will be 0.8 multiplied by 11. That will give you 8.88. 0.8 multiplied by 11. So you have 8.88. So the share of profits for zinc will give you 0.6 multiplied by 3.6. Okay. So 0.6 multiplied by 3.6. 2.16. So you can now put this one also together for them. So other components of equity will also be put together. 11 minus 5 minus 2 minus 1.9 plus 13. So we're having 15.1. So other components of equity workings number 5, 15.1. This will give us 25. Non-controlling interest will be workings 4. What are we having for that? So non-controlling interest will be 15 plus 9, 2.2 plus 1.44. So we have 27.64. Please, can you be confirming the figures for me? 27.64. 27.64.
It's correct. It's correct.
Okay. The retained earnings is what? 70 plus 2 plus 2, 0.68 plus minus 0.7 plus 0.4 minus 4 plus 8.8 plus 2.16. I'm getting 81.34.
Yes, 81.34.
Okay. So we have 81.34. That will be workings number 5, 81.34. Okay. So you can now put your liabilities together. 47 plus 6 plus 6.6 plus 3.6 plus 18, 81.2. Okay. So your non-current liabilities 53 plus 20 plus 0.8 plus 0.04 plus 21. 94.84. Okay. So our assets now 6 plus 0.8 plus 0.68. So this will give us 6 plus 0.8 minus 0.68. So 6.12. 15 plus this one will give us 29. 9 plus 6 plus 14. That will give us 29. Okay. So someone should take the non-current as PP for us. 5 plus 7 plus 8 plus 4 plus 12. So I'm having 36 as the current asset. So 5 plus 7 plus 8 plus 12. 5 plus 7 plus 8 plus 4 plus 12, 36. The PP is how much? 11, 2 plus 60.
248.
2 plus 4, 3.4 minus 2.6 plus 12 plus 13 plus 26. 248.8.
Yeah.
Okay. So plus 6 plus 29 plus 6.12 plus 36. So I'm having total to be 325.
Please, what from the 0.8?
It's 2.248 or not.
0.8 is not on it.
No, because this is 0.4 plus 0.6, so that should be a whole number.
No, it's not point with, they are all minus. Okay, let me see again. 11, 12 plus 60 plus 24 plus 4 minus 0.4 minus 2.6 plus 25 plus 26. Okay, 248. Okay. So it means that this would be 0.12 rather. Okay, 0.12. Okay. So 25 plus 81.34 plus 15.1. 121.44. Can someone confirm that? 27.64 plus 94.84 plus 81.2. 325.12. Yes, your job is not good. Your job, you are not going there to add figures. The examiner knows that if you total the figures, you'll be having a particular total. So they will just give you ticks for this calculation here. This will not give you any ticks. So they will give you ticks for all these figures one by one. So you can just put it over here because of time, you just leave this one. You don't have to total because the total there 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. Just 11 ticks. So you can just leave the what. You are not preparing the thing for your company. It is exam. So don't say that if you don't put the figures there, they are going to penalize you. No. Exam is not about how hardworking you are. It's how smart you are. Okay. So yes, you can just go there. Don't say that, oh, I haven't put the figures in the statement of financial position, so are they not going to penalize me? Nobody is going to penalize you. All right. So this is all about the step acquisition. That is the first question. We pick our second question on Saturday. That will be during normal class. The next week, we look at disposal, small. We will end the figure on we end everything on consolidation. So this is just a part 1, step acquisition. Any question? Okay. So I'll just take this one to mean that we don't have any question. So I'll go back to my sheet.
Sir,
Yes, please.
is it okay if I call you during the day? Let's say in the next 3 or 4 hours when you are awake by then. I'll allow you to sleep this morning if it's okay with you.
How do you think that I want to pause